We've got earnings in focus, and Kamlesh Gandhi, MD at Mass Financial Services, now joins in to talk about the quarter gone by. Good to have you on board. Good morning. And looking at your Q3 numbers, it has been a pretty strong growth on a year-on-year basis when it comes to your NIIs, your AUM, as well as your overall profit. And we've seen a record high quarterly disbursement as well at 1,600 crore rupees. What's driven this strong disbursement growth as well as strong growth on your headline numbers?
Good morning. As you rightly told, it was a very nice quarter for us, and especially when we are recovering and normalizing post-COVID. And what we had done during this COVID was to focus to strengthen our balance sheet, which helped us to increase our disbursement whenever we got the opportunity. And with normalization and with the focus approach on MSME, we could achieve this number. And as I talk to you, we have a very strong balance sheet in terms of more than 24% in Tier 1 capital, a good buffer in terms of COVID provisioning still being maintained at close to 0.95% of the total assets, and with the quality of assets within a range bound of less than 2% of stage 3, gave us the confidence to increase our disbursement this quarter.
Okay, moving on then, let's also focus in on the asset quality and the kind of profitability that the company is guiding. I understand a CAGR of 20 to 25% over the next 5 years. What is giving you the confidence, and what is going to be the outlook when it comes to your asset quality and maintaining it?
See, we are at more than a 2-decade-old NBFC, and right from the beginning, we are focused on this niche segment of MSME. And if you see throughout this decades, what we have focused is on creating quality assets. And at the same time, we have grown at a very healthy rate of 25% plus. If you even take our growth journey from 2007 to 2021, 14 long years after we raised our first capital, we have registered a 25% CAGR across all cycles. And we know that that was very tough cycles, the various tough cycles during this time. So what we have done in the past and the way we approach our businesses and the niche expertise what we have got in serving this MSME segment, accompanied by a very strong balance sheet, gives us the confidence that growing at 20-25% over the next 5 years, we have very strong enablers for the same.
So what you're saying is that any COVID impact is perhaps behind in terms of an adjustment and also in terms of in provisioning?
It's right to assume right now that whatever the pain of COVID was there has already been factored in, but still because of the uncertainty of third wave and all which persisted in the third quarter, we continue to maintain a very strong buffer of 0.95% of our total AUM as a COVID buffer.
And has your collection gone to pre-COVID levels, because the number stands at 97.5? So has that number gone before pre-COVID levels?
Yeah. And what we do is that when we project this 97.5% as the collection efficiency, it is against the billing versus the collection against that. So 97.5% has been our historical run rate in terms of collection. So it is back to the pre-COVID levels.
You're looking at increasing your balance sheet size when interest rates are likely to move higher. But if interest rates start moving higher, and if they go up, let's say 50 bips or 75 bips, could that start impacting your asset quality? It may not impact your asset quality this quarter, next quarter, but let's say post the interest rate hike of 1% of 75 bips, could that start impacting your asset quality?
Not really. If we see that across all this period, we have seen number of up and down in interest rate many times, and we might have to absorb the interest rate rise for a temporary period. And if it is on a sustained basis, then it can be passed on to the borrowers without affecting the quality of the assets. And that what we have focused over all these years is that not to create asset at any cost, but to create asset in such a manner which creates value for all its stakeholders. So we have navigated through such situation in the past, and we see no reason why it should affect our asset quality.
Hi, Mr. Gandhi. Good morning. Your stock for the month is up by about 13%. In that sense, you have outperformed the market. if you were to look at the fine print and you have a pulse of what's happening on ground, loans to SMEs, a big part of your assets under management. But for the quarter under review, the average ticket price has been what? 18 lakh rupees, down from 34 lakh rupees exactly a year ago. Why is that the case? Is it trending higher? What is it going to mean for your business?
See, we have just normalized. And as a lender, when the real economy normalizes, we are a cautious lender. So slowly and gradually, we'll be increasing the ticket size and we'll be coming back to our original levels of anywhere between 25 to 30 lakhs of rupees. So the ticket size, what we serve in the SME segment is right from 3 lakhs rupees to a 3 crore rupees loan. And then the focus changes as per the opportunity from quarter to quarter. But as we are normalizing, why we saw the opportunity, we would be cautious in increasing the ticket size, and hence you are seeing a little drop in the ticket size, but it is in lines with our business plans.
But just taking forward from what Nikunj was also pointing out, whether it comes to CVs, whether it comes to, lower income housing, or even loans to SMEs, isn't an interest rate hike, maybe overseas first, then followed it by India, a big headwind to watch out for?
See, we as NBFC address the unaddressable or the credit gap, which is very huge. So our customers are not that sensitive to the interest rates. And as I shared earlier, that we might have to absorb it temporarily, but later on we can very efficiently pass it on to the borrowers if it is on a sustained basis. And once again, we have been over these decades focused to see to that any changes, whether it is interest rates or any macro or micro changes, does not affect our asset quality, and we calibrate our disbursements and businesses accordingly.
What is the view when it comes to your provisioning going forward?
I think we have sufficient, as I shared, we have sufficient buffer as far as provisioning is concerned. And I think we will have a credit cost at around historical levels of around 0.8 to 1%.
All right, we'll let you go on that note. Appreciate your time. That's the view coming in from Mass Financial, talking about how they have seen the pain of COVID factored in, but they will continue to offer a buffer. They're focusing on creating healthy assets, and they are seeing strong enablers for growth of 20 to 25% over the next 5 years.